Every now and then something lands on my desk that makes me stop, blink twice and wonder, am I looking at bookkeeping or someone's Christmas list? This one nearly had me spitting out my tea, drunk of course from a new Hal Robson Carner Euro 2016 mug, and it involved a £2,000 Louis Vuitton bag. Apparently it was a tool bag, and I wish I were joking. We took on a new client recently, and as part of reviewing the bookkeeping, we started spotting the usual high risk areas: motor costs, travel, meals, clothing, and staff perks. Then up popped the Louis Vuitton holdall. Now, the explanation from the client was that it was bought for quality and durability and used 100% to carry tools, no personal use. Now, fair enough in theory, businesses of course can buy good quality equipment. You don't have to buy the cheapest option on the shelf, and HMRC don't get to have a say over that. But that isn't the real question here. The real question is, if HMRC looked at this, would they really believe it was bought wholly and exclusively for the business? And that's where the problem starts, because HMRC don't just look at one transaction in isolation, they look at patterns. And this bag was bought about 2 weeks before Christmas. On the same weekend, there was also a very expensive Saturday night meal put through as travel and subsistence. And there were also a lot of designer clothing purchases on the same trip. Now, the explanation there from the client was that the company logo would be added later to make them business clothes, and therefore they would be allowable. However, and it's a very big however, putting a logo on ordinary clothing doesn't magically turn it into tax-deductible uniform. And when you put together the luxury bag, designer clothes, the weekend meal, and Christmas time, you can see how HMRC might start asking very awkward questions. And this matters even more now because HMRC get far more data than they used to. Under Making Tax Digital, the VAT is no longer just a few boxes on a form. No, the underlying bookkeeping matters more and more because every transaction is sitting there in Xero or whatever accounting software is used. HMRC are increasingly using data, automation, and even AI to look for odd patterns and unusual items. And guess which areas tend to attract attention? Well, travel and subsistence, entertaining, sundry expenses, repairs and maintenance, staff perks, clothing, of course, and high-value items that look personal. In other words, exactly the sort of things that were appearing here. Now, that's why good accountants does more than just type numbers into software and hit submit. Our job is to challenge things done right and protect the client before HMRC ever get involved. Now, we're absolutely there to support all of our clients and help them save tax, but we need to save tax properly. We'll happily guide you and make sure you are claiming all the tax relief you can, including allowable perks or meals, but also guide you away from the ones that you can't claim. Now, in this case, the client dug in and said they're going to claim tax relief on these anyway, so we had to tell them we couldn't work them any longer. Not just because of one bag, but because of what it represented overall. And here's the simple lesson. If you try to justify an expense because it's expensive, nice, might have a logo added later, or you think you can probably explain it if anybody asks, you may already be on dangerous ground. The better question is, would HMRC see this as a genuine business cost or see it as personal spending you're dressing up as a business cost? Now, in case you think I'm being harsh, there were plenty of other things on this case too. Lots of travel and subsistence in restaurants very close to home, thousands and thousands of pounds worth of perks with no benefit in kind tax declared, and also claiming full tax and VAT relief, not just on the 2 fans they had, but 4 very expensive pool cars, all shared between only 3 people. But that's a story for another day.